let's maybe start just with some quick introductions. Let's just start with you, Thomas. Just a brief introduction of yourself, please, and then we'll move around the rest of the panel just so that everybody knows everybody.
Thomas Veith, I'm partner at PwC in Frankfurt, leading the real asset industry, meaning real estate as well as infrastructure in Germany, and I'm part of our EMEA and global board. 400 people in Germany focusing on real estate, around 20 people now focusing on ESG, and this group is fast growing, so we are hiring. And it's really, as Christiana said, it's an interdisciplinary play where you not only need the strategy view, but also the implementation, legal, tax things. I think that's something we have seen in several projects that's needed. I'm looking forward to the session.
Great, super. Richard.
My name is Richard Hamilton-Gray, Nuveen to top 5 real estate manager globally. We've got offices in over 25 cities around the world, and an AUM of around 130 billion US dollars. We've got a long history of responsible investing and impact capability, and we've received a number of accolades in that area. My role is to oversee the ESG program across our real estate portfolio in the Asia Pacific and the European markets.
Super, thanks very much. Assem.
Hi, my name is Assem Alami. I'm head of origination with Böhnlein HIP. We're a balance sheet lender, as many of you might know, and we've come up with a green fund brief for the first time, and actually we're today the biggest private issuer of green bonds and covered bonds and also uncovered. So the ESG agenda is really close to our hearts and close to our DNA, and we're actually rolling out our ESG agenda 2.0 already. So we're in the middle of that process right now.
Great, thanks very much. Peter.
Hi, I'm Peter. I'm leading the Austrian real estate department from PwC, and like Thomas said, we are very strong at the moment with ESG. We can see also interest of Austrian clients a lot to help them with the strategy and stuff like that, and it's also one of my personal interests coming up in the last couple of months.
Let's also just pick up with you, Jens, and obviously you had a bit of an introduction there from Christiana, so maybe let's start with you. Quick introduction of yourself, but then just talk us through the kind of latest news, really.
So my name is Jens Böhnlein. I'm responsible for global asset management. We have a couple of funds, but I'm mainly responsible for our real estate sector. Christiana teased a little bit regarding the Article 8 and Article 9, and yesterday we officially got the news that we would be certified as an Article 8 product, which Christiana somehow described as a light green product. I would say it's more into the darker greener side than the lighter greener side anyway, but it's, I think, great news, and from my perspective it's a sign to the market that such a big their portfolio and like the house investors, an open-ended fund with 16 billion under assets on a global scale, is now opting in to be Article 8, and I think that's now giving some market direction from our point of view.
Thomas, let's just start with you. What are the key things that you think people need to be looking at? We've obviously seen new regulation coming in, and we'll have an in-depth view on some of the regulatory and legal issues later on. But what, I suppose, what are you seeing as key points for investors and occupiers and the market in general around this topic?
I think there is a lot of demand and movement from the different, as Christiana said, from the different stakeholders. And all the stakeholders, if you talk to the occupiers that have their own ESG agenda, or the, as Böhnlein HIP is pretty advanced in this green lending, and insurance companies also have to reshape their portfolio into more green. So they are all pushing, and of course the investors, because their LPs, again, want to invest more green. And this also gives impact, is my gut feel, also on pricing, on rents, and hopefully at one point in time shortly also on valuation. I think this is subject to the next session, and this has to be reflected in the personal development and the personal strategy of each market participant. Yeah, and I see different trends. a lot of people as CO2 reduction is, let's say, the most advanced target also in the EU taxonomy. I hear a lot about net zero targets or CO2 reduction, which is to me, but only a short-term good reflex, but ESG is much broader. And I think that's important. And that's something that a lot of market participants should keep in mind, that other regulation, additional regulation of the 4 other EU targets will come shortly next year. So if you focus on CO2 now, it's good. It's a good starting point, but don't forget the other things. Otherwise, you will get a bit of stress beginning of next year or during next year. I think if you only focus on the net zero target.
Yeah, and Richard, you're obviously looking, as part of your remit, you're also looking at Asia Pac and different areas outside Europe. How are you seeing the strategies that you're having to develop there for Europe? And are they different in terms of Asia Pacific and also North America, if you've got that insight as well? How do you see that?
Yeah, the strategies that we're developing are based on the, let's say, transition risk. Well, the physical risk as well, but let's stay with transition risk for now. Are based on the transition risk, so the market expectation, the regulatory expectations of product, of real estate. I think that the key difference probably at the moment is that some of the time horizons that we're looking at for the Northern European market are more aggressive than some of those within the APAC region. And that's really a result of the strong corporate occupier market drive within a lot of the markets that we're deploying capital. It's also because of the growing regulatory framework within those markets that we're deploying capital in as well. So I think Thomas is right in the sense that the carbon reduction piece is still the primary frame of reference, and that is because there's more of a direct cash flow impact of climate risk than, let's say, some of the other thematic areas that the European taxonomy has highlighted, for example, biodiversity. But I think that it primarily comes down to the time horizons. I think what's been quite interesting looking at the APAC region is that actually over the past 6 months or so, you've seen the likes of China, South Korea, Japan, all now making quite explicit commitments around carbon reduction in particular, and therefore it's a quite bifurcated region. But there's definitely this growing kind of overall trend that these commitments are being made, which, to be honest with you, 2-3 years ago, I don't think that we would necessarily have expected for them to materialize. So I think the time horizon's the main thing there. Okay,
good. And Assem, obviously, Richard there mentioned the kind of transitional risk. And Jens also highlighted a little bit in terms of the assets there. So as a kind of banker finance provider, are you adjusting your strategies in order to fit more with the change in terms of ESG, particularly that we've seen over the last 2 to 3 years, as Richard mentioned, but especially over the last year?
Yeah, well, we've sort of been the first mover on that field among the German lenders, and we've incentivized the loans that concerned green assets. Concerns the new assets. What we're now trying to finance or to incentivize are the buildings, as Richard said, that bear transitional risk. So gray buildings, so to speak, that have to go green, that you have to turn into a energy efficient and CO2 poor building, and that's a whole different subject, because that doesn't concern any not only the certain goals in terms of energy efficiency as you might want to measure it for new buildings, but you want to measure the decrease of CO2 emissions. So in that sense, a building which complies with our transitional or transformation facility requirements is not necessarily one which will have a certificate BREEAM, heavy gold or platinum, but where we can say that there's a significant reduction in CO2 production. So to put it into targets for us, we aim to have a 30% green portfolio by 2025, and that's quite a challenge, because the first 20% that we achieved now were relatively not easy, but easier to achieve. I would expect now that the additional effort to not only to get the new buildings, but to get old buildings to be transformed into energy efficient buildings will be much more fastidious.
Okay, good. And Jens, I mean, in terms of Commerz Real, obviously there are different strategies. One of which is investing, I suppose, in newer, already ESG compliant buildings, or better than compliant in that sense. But a huge amount of the built environment is obviously already standing assets. So I suppose, how do you develop how do you link between those two strategies, Jens?
I think this is the most tricky question, actually. And before we actually took the decision that we wanted to become an Article 8 product, we did kind of an investigation how we're standing against the climate targets of Paris. What you need to do is really to get a good understanding of your assets, where they stand. And what you need to consider is that every decision you take today will have an impact in 10 or 20 years' time. And if we're now thinking about 2050, that's quite close. If you take into consideration that you have a huge portfolio which you want to likely keep because it has great locations, great buildings, etc., etc. So you have to find kind of a mix of a balance of really, really good buildings, which you just mentioned, that you need to get on board and acquire. And on the other side, you have to find some smart solution how you can improve your existing stock. Luckily, we do have a quite good portfolio. We've worked together with Scope last year and gave kind of an insight where we are with our CO2 footprint. And now we're trying to identify, let's say, the worst buildings that we have to concentrate on those and improve them in a short period of time in order to allow us to still follow the pathway of reducing our CO2 footprint. I just want to add one more comment to Thomas and can only confirm what he said. When we did the conversations, to get the products being approved, it became quite clear that ESG is meant in all three areas and not only in terms of CO2 reduction. So there's going to be a massive pressure, and you have to think not only about the buildings, but also about your processes which you run on the buildings, because that's part of the ESG story as well.
I think that the point that was made around the BREEAM certification, for example, not necessarily aligning with transition risk, so to speak, is I think a really valuable one. And I think it's fair to say that many of the standards that are out there, that the certification regimes, they don't necessarily efficiently communicate investment risk per se. So ultimately, what do all of these metrics mean? You've got GRESB, obviously at the portfolio level, you've got BREEAM at the asset level and various others, but what does that actually mean in terms of portfolio and asset level performance? And I think that's where the recommendations from TCFD and tools from the Carbon Risk Real Estate Monitor, for example, are quite useful there, because they bring to life a more real-time insight into the balance sheet of an entity, either at asset or portfolio level, from which more informed investment decision can be made, rather than just relying on, let's say, abstract indicators of that risk in the form of the different ESG metrics that those types of regimes considers. And that's why, as part of our client engagement, we're trying to now provide more meaningful figures to them, so that they can understand that transition risk within their portfolio. from which they can then make more strategic investment, or that we can make more strategic investment recommendations to them. So, for example, we've looked at identifying what those asset level capital investment plans need to be to transition these assets to protect or mitigate against obsolescence risk. And then think about what that capital investment plan actually means in terms of the marginal capital investment you're going to have to spend over the whole period, and showing that in relation to the net asset value of a portfolio, or the value of that asset, so that you can understand the extent to which that risk, that transition risk, can be managed through cash flow, perhaps through inward yield shift on exit, or greater rental reward. And I think clearly, as well as being able to communicate that to your clients in a meaningful way, it's also really important for us, going back to the point that was just made around, strategic portfolio management. If we know that we've got residual risk or latent risk within the portfolio regarding, the amounts of capex we're going to have to spend on these properties, and some careful consideration needs to be made around divestment.
Okay, great. There's a question come in, which is great, which is, can you highlight some of the other ESG issues other than CO2 and BREEAM matters that investors should be considering? That's from David Allen. Thanks, David. Thank you for joining us.
We talked a lot about CO2 reduction, but governmental and social aspects are quite important as well. So you can, and I think that's a question that you have to ask yourself as well. Yeah, if you go into the topic, you need to identify a purpose for your company, whether you offer it to investors or you offer it to your own entity, and then you will define what S&G does mean. For Commerz, we do have a really clear governance process. We are a fully 100% daughter of an affiliate of Commerzbank. So we do have quite some strong regulations. So G is usually for us to tick the box because we do already have the processes in place. But it comes down to S. You have to rethink about, what you want to achieve. You cannot necessarily buy in cheap property management services. You have to think about, who's standing at the front door, who's standing at the desk. How do you want to manage your portfolio? How do you want to manage your assets, et cetera, et cetera. And what I can share here is we already received some, let's say, questionnaires from corporates as well. So from the tenant side, they will be kind of, or they will have the obligation as well to demonstrate whether they are ESG compliant in the future. And they will ask you some tricky questions. What type of material you're using? Where's your workforce coming from? How do you ensure that the process is running right, etc.? So a lot of questions usually you would not necessarily see within the real estate industry that are now popping up, and you have to really understand, what you can answer today, and then just try to find a pathway to come to a point where you can confirm with what you believe ESG is. Article 8 is not so much straightforward than Article 9. So there's still some room to find a good definition. But now with more products coming into the market, very likely the regulation will become very strict, and they will try to drive things into one direction. So I think right now is a good point in time to think about your own processes.
Okay, good. And Peter, I just wanted to come to you. Christiana mentioned that, hiding behind greenwashing and those kinds of things were already becoming increasingly difficult. What's your sense of that? I suppose, what are you seeing in terms of partly how these strategies are being implemented and the take-up within the industry?
What we can see in the last months is there's beside of Jens and the guys from Commerz, there's a lot of interest to bring it to the daily business. So from my perspective, ESG is not, as Richard mentioned 2 or 3 years ago, I was smiling when Susanne Eickelmann-Riepe mentioned ESG. Now it's here. So she was a kind of prophet in here. Now it's here. Now it's our daily business. So what now will happen, or already is happening, is that from the strategy, the next step must be to the assets. And it's also everything was said about that. The problem is not the problem. The challenge is the old stock. The challenge is heritage protected buildings, for example, in Austria, where we have a lot of. Now we have to learn, and everybody have to learn how to bring the strategy to the ground and feel and live this mind change in the asset management and the investment management. And this is what Jens already mentioned, is it's a kind of, we have to restructure our structure, and we have to do our internal work to bring ESG as a part of our life. And that is not something what is just from the European Union. We should do it for our own interests. And what I see in the discussions with a lot of CEOs here in Austria and also CE area, they, in the meanwhile, that's not an obstacle or a problem for them. They see it as a chance for new market. And this is something where we can do something against our employment. We can, I see it as a big challenge. But the challenge is the very, very old mindset of the real estate industry, and that we have to learn now to structure our portfolios in a new way. We have to redefine our processes, and we have to learn our business new again. And guys, I'm 15 years old. It's very hard for me to learn something.
Great, thanks, Peter. We've got some more questions coming in, so thanks very much for those, and we'll deal with all of them. Question coming in from Elena Bolito here, which is, thanks for that, Elena. Are the three different products, Articles 6 to 8 and SFDR, applicable to collective investment vehicles and strategic partnerships?
I think the rules have to be applied by regulated products for now. But our clear view on the market in the near future already is that even unregulated product will somehow must be identified as where they are green, non-green, dark green, light green. So we assume that even in non-regulated products, joint ventures, etc., somehow this EU regulation will also be applied. That's a clear view, and it's always interesting to see if I don't know, a Japanese investor invests via a UK structure into a German asset, which rules have to be applied. And currently we see that the EU is pretty or most advanced around the globe, and even our international network assumes that other countries outside the EU will somehow orientate on our rules here, and even outside the regulated world, because even in joint ventures, investors will ask, is it a green investment or not? And greenwashing is not possible. And if there are clear rules in the market for the regulated world, I assume they will be applied also for the non-regulated part of the world.
Okay, great. Quick question coming in as well from Omar Sattar from Crowdberry. Thanks for joining us, Omar. Good to see you here. Which is around that embedded carbons one, which I think is an interesting one. So I believe embedded carbons in buildings, especially for, say, existing standing assets and even their planned future capex improvement to make the asset more friendly to the environment, are not given a high enough weighting as they should be compared to a new or greenfield development when looked at the lens of a rating or measurement framework. Would the panel agree or disagree?
I absolutely agree with that. I think the challenge is that at the moment, and we'll go back to the point of this session, the market at the moment isn't necessarily pricing in the embodied piece. It's closer towards pricing in the operational carbon, which is why there's perhaps a focus at the moment on achieving operational optimization, perhaps at the expense of the embodied carbon piece. You know, for the pieces of work that we do take a whole life carbon approach, but you know, because there's going to be new stock coming online, or there has to be new stock coming online in order to meet the Paris agreements that is operationally net zero carbon by 2030. It means that if we're not delivering operationally net zero carbon stock to the market, then we're going to get discounted for that. So there needs to be wider work, I suppose, done and wider position papers released by the industry so that it's internalised and understood by the market more.
Angus Johnson, thanks very much for joining, and also from PwC and putting in the chat that if it's a collective investment scheme, if it's an AIF, then it is caught. And you'll also be able to, I did an interview with Angus, which will be part of the programme immediately after this panel, so you can also catch up with Angus's views on other areas of this as well. I mean, as a bank, how difficult does it make it for you? I mean, because we'll be looking at valuations later, but as a bank, obviously you've got to look at those valuations in terms of ESG as well. So how do you structure that in? Does that create more of an issue going forward in terms of risk as far as the kind of the bank's view is concerned?
Well, it's clearly that the impact in values, and thus in our risk assessment, will increase throughout the time. The nearer we get to the 2050 deadline, the more the market will react, and we will have to factor in the transitional risks that were already mentioned. Just to give you an example, 3 weeks ago, Allianz mentioned in the Mobilien Zeitung, sorry, Richard, to cite in different media, that they will not buy any assets anymore which don't have the possibility to be transformed into climate neutral efficiency. I think that shows the way where the investment community will go. And as a bank, of course we will have to factor in the decreasing liquidity of an asset and thus a higher risk premium.
Thomas, in terms of how you see this, whether you see this as a challenge, as an opportunity, plainly there is increasing regulation. We can already see that, and there's more coming down the line. But how do you see that? I mean, do you think there is an opportunity, particularly for the real estate side, within this?
Of course, I'm always a positive person, but I really think that there are so many opportunities coming out of that. And it's also the wrong view to say, oh, a new regulation, it's an additional burden, blah, blah, blah. So we are advising some clients on transformational products as well on the asset side, as well as on the mezzanine side. And if you finance or invest into this transformational part and optimize buildings, and if you look at Germany, we have so many stock from the 50s, 60s, 70s. All these buildings have to be recycled somehow at some point in time. And it's a really opportunity to transform these assets into an ESG compliant, of course, CO2 reduced assets. And it's not so, or you can finance the situations, and then it's not so difficult to even get an Article 9 product, because the reduction of CO2, which is now let's say the major KPI, it's a short-term view, of course. In the midterm, there must be more. It's a big opportunity for classical core plus value-add investors to buy this asset. Of course, you have to identify ESG as a value driver. Otherwise, you will never find a seller who is selling at the price level. If you just take the market value today and reduce capex, that doesn't make sense, because you also have to identify the value drivers out of the ESG. So potentially lower vacancy rates, potentially higher rents, lower cap rates within this business plan to make sense out of that. And then it's a huge opportunity. Just talking about the German market, where I know the stock a bit better on the asset level, it's a great opportunity, and we see movement. And if we're talking to some of the clients, and they haven't identified this opportunity, they said they were really surprised, saying, "Well, we can really do an Article 9 product by financing via MES or whole loans, or invest in this type of assets," which is really a great opportunity. For this, of course, if you have existing stock and can't really move somehow because the cash is you don't have the cash for the capex or whatever, perhaps Berlin Hüb can finance this with transformational loans. But then if you are then stuck and just wait, it might work for the next 1 or 2 years, but in the long and midterm, I think you will definitely use value and money.
Okay, good. Richard, I just wanted to come to you briefly. There's obviously a lot of mention around impact funds as well as ESG compliant funds. How do you see, from a Nuveen perspective, the differences between those two?
Well, I think that from an impact investing standpoint, I think as responsible investment has moved into the mainstream, there's a growing mobilization of capital that's looking for strategies that go beyond just traditional ESG principles. And in response, many investors are embracing impact investing, which looks to produce direct benefits for people and for planet, whilst generating market rate returns. Impact funds differ from ESG product per se by targeting very specific outcomes rather than simply avoiding companies on the indirect side or direct property investments that, let's say, are carbon intensive or produce tobacco, for example. I think a prerequisite for the impact investment is that you have to be upfront about the intentionality, the intentionality of the impact that you're looking to achieve, developing a scorecard on that basis to be transparent about how you're prioritizing deal flow and filtering those different opportunities, and then being very explicit around the additionality that you're looking to deliver in terms of jobs created or X% reduction in carbon versus baseline, and then having a measurement and a verification process in place to assess performance against that criteria. That's also called an impact management and measurement framework. So that I'll stop there.
Okay, that's good. And Peter, just what are you seeing from your part of the world, particularly there in Austria?
There was a very interesting word said by Richard right now. It's regarding the deal flow. This is something where we absolutely see minds change also at the moment. When you tried, for example, to say a sale brownfield or greenfield project to some institutional investors, the ask are completely different since 1 year ago. That's point number one. And secondly, what I also want to pick up a little bit is the yield shift. I'm not pretty sure that we will see better prices or lower prices on that, because it's something what we just have to do. And it would be really interesting for me, like, for example, how Nuveen is this seeing, or Commerz is this seeing. What is this a major impact on the investor side, for example, for a standing investment or for a brownfield project? Is this something what you're pricing in right now? So what we see in the market now, they start to price it in, but what is the price on ESG? That's the big question, what we have to figure out in the next months, because this will also have a big influence on deal flow on the one hand, on the asset management level in anyhow. So let's for a second try to figure out what is the idea on the deal flow side, on the yield shift.
I think I understand the question. I think that in the short term, so and again, the rate of transition risk varies market to market, but I think that for Central London office, for example, JLL have come out and said the time horizon for kind of short-term upside in the value arbitrage of net zero carbon stock being delivered to the market is around 5 years. But by 10 years, it's really going to be about mitigating downside transition risk, i.e. you'll get to a certain level of adoption of net zero carbon within the market, whereby discounts then take hold. I think separately, in response to that, some of the analysis that we're doing specific for our impact products is to develop dedicated net zero carbon investment plans as part of our transaction underwriting. And of course, the plausibility of getting cap rate shift on exit as part of that additional capital investment that comes out in the underwrite definitely feeds into that. To be honest with you, it's going to vary a lot because real estate's a heterogeneous asset class, but some of the figures that we're seeing are like 25 bips of yield compression on exit by 2030. I mean, for me, 25 bips doesn't seem hugely significant. But then, as I say, real estate is a heterogeneous asset class, and there's a lot of asset specific risk. So what it means is that your technical underwriting has to be absolutely spot on.
If we were to come back to this in 6 months' time, which I hope we do we expect this to have accelerated more? How do we see this progressing? So, just kind of 20 seconds each on that, really. Let's start with you, Assem. I suppose just how do you see this moving forward, and particularly around the strategies?
All right. First of all, do I expect this to pick up speed? Yes, I do. If it doesn't, then the legislator will provide for picking up speed at one point or another, because it is a necessity. There's no choice anymore. We need to go towards these Paris 2050 targets, and it's a big question if we still can make the 2% target anyway. Well, that's basically the 20 seconds I used for.
That's good. Okay, Jens.
Yeah, I can only confirm. I think it's going to accelerate quite significantly in the next coming months with more and more products getting out to the market. There will be Article 8, but I think there's likely going to be more Article 9 products on the market. As we've outlined, there's a new opportunity for making new products, and the market will very quickly pick this up. So yeah, answer is yes.
Okay, great. Peter.
It's all been said. I think it's moving on, and it's moving on faster and faster. And I think there's a lot of work coming up, a lot of fun coming up. So looking forward for the next 6 months.
Thanks very much for joining us.